All right, I'm curious to know what you think about Elon Musk's recent posts. He's making a connection between the work that DOGE is doing to make the government more efficient and the correlating interest rates on different types of loans out there, including mortgages. If you don't know how one connects to the other, here's what he's saying in this post, is that by cutting all these costs, even though they're a very small percentage of our national debt, it instills confidence in our government. And now people want to invest in the government, essentially lend government money in the form of these treasury bonds. These are just investment vehicles, right? Now, loans for cars and for houses, those are investment vehicles too. So they compete with each other. That's why the loan on a house that somebody can buy, an investor can buy that loan, a mortgage-backed security, right? That's basically saying I get a return on my money, and that's the interest rate that the borrower is paying on that home loan. Well, those compete with like the 10-year treasury bonds, and that's why the mortgage rates for houses follow the 10-year treasury bonds, because they're all competing investment vehicles, these loans that you can buy for a return on your money. So Elon Musk's logic here is saying that, look, as confidence in the government grows about its financial responsibility, about the prospect of us addressing our national debt in the future grows, then there's going to be more demand for these bonds for the government, and those compete with other bonds and loans out there, investment vehicles. And so you're going to see this cascading effect of these bond vehicles, investment vehicles competing with each other, and the rates dropping. So as demand for these investment vehicles grows, the yield can be lower. When there is no demand for bonds and for mortgage-backed securities and so forth, because there's perceived risk with them, for example, then mortgage rates go up. That's how that works. So high demand for these investment vehicles, the lower the yields, the better the rates for the borrowers. The less demand for these investment vehicles, then the higher the rates have to be to attract those investments or investors to buy them, whether they're institutional investors, they're sovereign countries and so forth, or they're individual mom and pop investors like you and me. That's the logic here. But if the Federal Reserve doesn't cut the Fed rates, I'm curious to know what you think, because there are other forces at play. So look, if you can get TDS out of the picture for your reflexive hatred for everything that Trump does and people around him do, if that's you, just don't even comment. But if you have objective reasoning still, I'm kind of curious to know what you think about this post. Do you think that the work that DOGE is doing and its cutting costs is going to affect loan rates or not?